A very common question I get from people who have bank on yourself type whole life insurance policies, and for people who are thinking about getting one, is how do I know when to take a policy loan or not? Um, we've done videos about how policy loans work, kind of the nuts and bolts of it, but what about the like, how do I decide when it's the right time to use a policy loan or take a different option? So, what I wanted to do in today's video is share a little bit of my rules of thumb for policy loans, the kinds of things I think about, as well as a real example of the math that I do. But when I'm trying to choose between a couple options when it came to making a recent major purchase for our family. So, I'm going to share my screen if you're watching on YouTube. If you're checking out the podcast version, you should be able to follow everything. But if you want to watch the YouTube, we'll put the link in the show notes. Welcome to the FIFE Movement. I'm your host, Amanda Neely. This is the only movement that helps our generation create our unique, feminine, and entrepreneurial path to financial independence. So glad you're here. Please be sure to subscribe so you get all kinds of yummy content. This isn't usually something that I would talk about here, but I've been getting so many questions about it. I thought I should. So let me share this little Word doc that I put together so that you can follow along with my rules of thumb and then the case study. I've got 7 rules of thumb that I want to talk about. So the first one is to think like a banker. What do I mean here? Imagine you're sitting in a bank and you can watch the money come in the front door, people depositing the money in, right? That's kind of wherever your income comes from, that's where it's coming. And you might also see money leaving the front door. Um, in terms of people, if you're the banker, they're taking their cash out of the bank. That might be your regular expenses, right? You've got to pay your mortgage or your rent, you got to buy groceries, that kind of thing, but hopefully you're keeping some money in the bank. And when you're thinking like a banker, you're thinking about how do you make sure that that money grows? And there's kind of a backdoor to the bank where the money can go out and do certain things just to help it grow. And then it comes back into the bank, and then goes back out right through that back door. And it's not so much the transactional things that are happening through the front door, but that's how the bank makes a lot of its money, is what it does with the funds that are there. People taking loans, maybe the bank buys, I don't know, tons of banks have cash value life insurance. There's actually a whole thing called bank owned life insurance. So when you're thinking like a banker, this is what I'm thinking. This is what I kind of mean. Yeah, you're watching the front door, but really you're thinking about the back door more so, right? What's happening with that cash to help it grow? How are you making sure you're being a good steward of those funds? There's a lot more that goes into thinking like a banker, but that's kind of the mindset you want to be in when you're approaching, should I take a policy loan or not, is the backdoor mindset instead of the front door mindset, right? Okay. So number 2 here is again kind of a mindset thing, but you want to kind of think about repaying loans as saving on the other side of the purchase. So you might have a policy and you're putting your premiums there, therefore more of the long term retirement, maybe your kids, college, different things that you're setting aside this money for that you want to use it for. And then you're looking at, well, I need, in the case study I'm going to use later, I need new windows for my house. I could use this longer term savings to purchase those windows, and then I could save back up for that longer term, passive income in retirement or whatever it is, on the other side of the purchase, right? So I'm going to take this money out, and then I'm going to have a plan for how I put it back so that it's still there for what I need it and want it for long term. And so when you remember we're thinking like a banker, the money is going out to go do something useful, something you do anyway, but you want to recapitalize the bank, right? You want the money back in there so that you have it for the next thing that you need. And that we call that saving on the other side of the purchase. Number 3, plan ahead. This isn't something that you just do all willy-nilly like. You want to have a game plan. Um, in the case study I'm going to use, right, we were getting an estimate for a project. We got the estimate, ran the numbers, we put our game plan together, and then we moved forward. We didn't just like decide on the spot, that kind of thing. Same kind of thing if you're like going to go buy a car, if you have a game plan before you go buy the car, you can often negotiate better, get a better deal on that car, things like that. So um, uh, especially with major purchases, you want to plan ahead, have a game plan, what you're going to do, and get your money lined up so that it's ready for that game plan. Number 4 here, do keep an eye on your loan to value ratio, how much money you have still there, right? Your value, your current cash value, and how much is loaned out of the policy to go do the things that you need. Um, and each person might have their unique ratio. A good rule of thumb to kind of aim for is 50-50, so that you still have about 50% of whatever your value is for that next emergency or that next opportunity, right? You don't want to over leverage all of your value, right? In a bunch of different ways. There are times when that might be necessary or important, but oftentimes you want to make sure you're keeping some cash available, especially for an emergency or an opportunity. Um, so keep an eye on that. Maybe only loan out 50% at one time, and you just have to wait until you get more cash value in order to go do that next thing you're thinking about doing. But it also gives you the opportunity to think about, as you get closer to when you're going to say turn this into passive income or use it for some of those longer term things, you're able to make sure that you're going to have the value there that you really want there, right? The loans are going to be paid back in time. You're going to have the cash value that you prepared to have when you prepared to have it. And you got to keep an eye on that ratio to make sure that you're hopefully maybe at 100% value, 0% loans whenever that long term thing hits, right? Um, so hopefully that made sense. Number 5 here, budget your cash value. This is kind of like keeping an eye on the ratio, but it gets a little more specific. Um, when you're looking at how much cash value you actually have, we like to use the whole idea of you give every dollar a job, or you're assigning roles for those dollars. And we talked about this in episode 85 of FIFE Movement. I'll put a link to that in the show notes if you want to check that out, where you would take your cash value and you'd say, okay, this is how much I need for emergencies. Here's how much I need for that next car that I'm going to purchase. Here's how, and you give those dollars a job so that you're not counting money twice, right? And you can even say when you take out a loan, oh, those dollars were for this job, so I can't give them to any other job that might exist until I'm repaying that loan. Number 6 here, still use the banks to your advantage. You won't always take a policy loan. You might get some good deals from banks with low interest. Might make sense for you with your cash flow and all of that. So don't just assume you're never going to use a bank again. Still look at those options, review them, see how they'd work for you. And then number 7, this is, I think, most important. When you are working with a bank and yourself professional, you have someone to talk with. And you want to talk with them, get their feedback, have them help you run the numbers, make sure you're not missing anything, and make sure you always remember that you're in control of your own cash. And when you are using your own money, you often have more control to negotiate or get different deals and that kind of thing. Um, and we, can explore that as well in terms of like the numbers and what that looks like. So, without further ado, let me run through the example that I wanted. You can see these 7 rules of thumb, which of course are meant to be broken, in action. So here's the example. We were going to make a $9,774 purchase. That's the number at the bottom of the estimate, how much it was going to cost. And of course, right there on the estimate, the company let us know they have a 0% offer for 12 months, same as cash, right? If you these are windows for our home, which we got a great deal on. I understand they can be a lot more than $9,000, $10,000, but our home is small, right? So it makes sense. Anyway, so this is the deal that they gave us. We could get the windows, pay it off within 12 months, and we wouldn't pay any interest. When we did the math, we took the total purchase amount divided by 12 months, we realized we'd have to pay 900 or sorry, $814.50 per month to make sure that we got it done in those 12 months. We weren't sure, we hadn't seen the fine print yet. We weren't sure if maybe in the 13th month they would back charge interest from those first 12 months or what the interest rate would be in the 13th month. But regardless of what would happen in the 13th month, we're like, we for sure would want to pay this off in 12 months so we don't have to pay any interest on this money. So that's what the game plan would be if we chose option one. $814.50 per month. We'd probably set it up automatic. It would, have to happen. Option two was to actually pay cash by using a policy loan. And here, the magic words that we used, we went back to the guy who gave us the estimate and we said, well, how much is it if we pay cash? Do you offer any kind of cash discount? And his response was, after I think he had to check with his manager, was, we'll give you a 3% discount. The 3% is what the credit card company was going to charge them anyway to process the credit card. So since they weren't going to have to pay that, they could give us the discount. That so we're like, okay, let's do the math on that. So we took that 9,774, found 3% of that, $293 discount. Woo woo, and 22 cents. Doesn't seem like a lot, but then we thought, okay, well, what if we used a little bit of the cash that we do have on hand? We keep a little bit just in a savings account, kind of, to for the short term, larger things that might happen, and then combine that with a policy loan. And when we did the math based on how much cash we had on hand and then how much the policy loan was going to need to be, we found that we'd have to pay ourselves back $315 per month in order for the loan interest to be less than the discount, right? So that we wouldn't get this discount and then end up paying more in interest on the policy loan. If we paid $315 per month, it would make sense and would be like equivalent to the 0% offer that they were offering us, right? So the result was that we were thinking $500 less from our cash flow. Remember, option one was about $815, paying back ourselves $315. That was $500 as entrepreneurs, as people who have fluctuating income. That $500 extra in our cash flow seemed like a lot. And so we were leaning toward option two. And we moved forward with that. We put in our deposit, which we had enough just cash on hand to do that deposit. And then it took months because of COVID for the windows to be made. It took months and months. And during those months, we made some smart choices while we were waiting. We'd have a little bit of like gamification of our money where we look for, good value. We, try to be healthy. So we're not like splurging on unhealthy food, right? We do family adventures that cost nothing, and we kind of make it a game for how little can we spend today and have so much fun, and all kinds of things in there. I think so. We made some smart choices while we were waiting, and that meant we didn't have to take a policy loan after all. We were actually able, during the months that we were waiting, able to save up enough to just pay the full balance without taking a policy loan. And so we got that entire discount, the $293, and we didn't have to worry about any kind of cash flow crunch moving forward to save on the other side of the loan. That kind of, or the other side of the purchase kind of goes to that whole idea of, thinking like a banker, but really, um, planning ahead, right? There were months in there where we were able to have some fun with our money, make it a game, and come up with the funds that we needed before they were actually due. But we knew also that we didn't have to do that. We could use the policy loan and it would totally work. So that's kind of a rule of thumb of what I think about when I'm thinking about doing a policy loan, and an example of the kind of numbers that I run. If you'd like those kind of numbers run for you, I'd love to do that. Please reach out to me. We've got some calculators that we use, or if you work with another bank on yourself professional, reach out to them. Um, the probably the worst thing you can do is make all these decisions in a silo all by yourself. But the more minds, the better, to help you think of things that you wouldn't think of otherwise. Excuse me. So that's it for today. Hope this has been helpful. Again, this is a question I get a lot. I'd love to know, when you're thinking about making a major purchase, what other rules of thumb do you use? Please share those in the comments on the YouTube video. And be sure you like the video while you're there. And whether you're checking this out on the podcast version or on YouTube, be sure to subscribe so that you get future episodes as well. For now, thanks for joining me and connecting with the FIFE movement. As you go about your day today, remember, wealth is coming your way. Your quest is to prepare for using it well and actually doing the numbers, thinking through how to make major purchases can be a really big thing in terms of, using your wealth wisely. And don't forget, the windows made sense for us, because the windows that were here were from the 1970s. They hadn't been replaced since then, and we're going to save a ton of money on our electric and heat bills going forward. That will pay more than pay for the windows, not to mention the property value, right? All of those kind of things too. You keep in mind when you're making those major purchases. Kind of our fun example there is, if you were going to buy a Toyota and for your next car, but your policy says you have enough money to go buy a Lamborghini, doesn't mean you should go buy a Lamborghini. You still do the things you're going to do anyway. You be smart about it, and use your money to grow your wealth and bring you to financial independence, your unique definition of that. That's it for today. I'll catch you tomorrow with Trivia Tuesday.